Hi friends, hello all. In this video, I'm going to cover the syllabus of JAB paper 2, that is accounting and finance, so that it may be helpful for your exam coming this weekend. So basically, the JAB syllabus of accounting, that is paper 2, is divided into four parts, that is module A, B, C and D. And module A is basics of business mathematics, that is calculation of interest, yield to maturity, depreciation, and basics of foreign exchange arithmetic. Whereas coming to module B, it is the basics of your accounting standards, that is what are the basic accounting procedures, what are the types of accounts, how do you classify the types of accounts, and bank reconciliation statement, and another important topic in this is bill of exchange. And coming to module C is basics of your financial statements, that is balance sheet equation, your P&L account, balance sheet, and types of companies account. And whereas module D comes of all the basics of operational parts, like operational aspects related to the accounting entries, operational aspects relating to advances, operational aspects related to your deposit accounts, etc. So basically module D can be covered easily by self-reading, that is you can from this Macmillan textbook prescribed for your JAB, you will have this part of at the end of each chapter you will have this summary, let's sum up and some terminal questions. So if you go through all those questions of module D, then your module D preparation will be done. So I'll try to cover module D also. I'll try to summarize all the bits on a single sheet and try to explain you. But in this video, I'll cover your module A and module B. So let's start for the session. Basically, your module A, that is calculation of interest and annuities. So basically, what is interest? Interest is nothing but the amount. What is interest is nothing but the amount or price you pay for the money for a period, that is price we pay for the money borrowed for a particular period. That is whenever we borrow some amount of money for a particular period of time, we need to pay some interest, that is we need to pay some higher amount for that, we need to pay a price for that. The price paid for the amount borrowed is nothing but interest. And interest is basically of two types, that is one is simple interest and another is compound interest. The simple interest is nothing but the interest is charged during the given period is only once, whereas the compound interest is charged more number of times during the given period of time. That is you have borrowed say amount of 100 rupees for a period of 1 year. If interest is charged only once during the entire period of 1 year, that is say at the end of the year, then it is called simple interest. Another way, if the interest is charged more than once, say two times, that is twice, semi-annually, interest is charged for a period of 6 months, then the overall amount interest you paid is nothing but a compound interest. Always the compound interest will be more compared to your simple interest. The basic formula of calculation of simple interest is, as we know, I is equals to PTR by 100, where P is principal, T is time period, R is rate of interest in percentage, so divided by 100. So I you get us the amount of interest to be paid. Say in our example we have borrowed amount of 100 rupees, say for a period of 1 year, then the interest, simple interest to be paid on this is I is equals to PTR by 100, that is principal 100 into time period 1 year, and say interest rate is 10%, then I is equals to 10 by 100, so interest to be paid is rupees 10. Similarly, if this is compound interest, that is interest charged is semi-annually, so first interest is PTR by 100, that is nothing but 100 into, so we assume it is for 2 years, so at the end of second year we are paying the interest of 10 rupees, sorry it is into 2, so we are paying interest of 20. Now I assume that if this is annually, that is twice, for every, at the end of each year we are going to pay the interest, Then I is equals to I1 is equals to nothing but 100 into T into R by 100, that is 10, and I2 is equals to, now principal is nothing but 100 plus 10, that is 110, plus 1 into 10 by 100, that is 11 rupees. So total interest paid is 21, whereas in simple interest total interest being paid is 20. So interest compounded is more, so more number of times we compound in a given period, more the interest we pay. Clear? Yeah. So coming to the formula, I is equals to PTR by 100 is simple interest. For calculation of compound interest, we have a formula that is A is equals to P into 1 plus R by N whole to the power of NT. A is principal plus interest and P is the principal. R is the rate at which we borrowed and N is the number of times in an year we compounded. T is total number of years, that is total time period in years. Basic important thing in this module is one point that is called rule of 72. Rule of 72 is nothing but this rule gives you the time period within which the amount you invested becomes double. That is the period, the minimum period or the period in which my amount I am depositing will get doubled. That is called rule of 72. The formula says, the rule of 72 formula is nothing but 72 divided by R, that is always R in percentage. So 72 divided by R, whatever the answer is nothing but the those number of years in which your amount gets doubled. Say the rate of interest which your banker is offering is 12%, then whatever the amount you invest with your bank will get double in 72 divided by 12, that is 6 years. In 6 years the amounts, if you are investing 100 rupees with your bank at rate of interest of 12%, then within 6 years your 100 will become 200. That is rule of 72. Very important. Rule of 72 is nothing but the period within which the amount you invested gets doubled, and it is arrived by dividing 72 with the rate of interest being paid. Remember, it is R in percentage only. So if the rate of interest is 12%, you need to divide 72 by 12 only, not 0.12. Do remember that. Then some other basic concepts: front end interest and back end interest. Front end and back end interest is nothing but the period, they are basically classified based on the period when interest is being levied. That is, if interest is being levied at the initial period, the initial of the taking the amount, then it is called front end interest. And if interest is paid back end, that is after the amount is taken, it is called back end interest. That is nothing but, in front end interest, whenever you are taking some amount, the interest is deducted and the net amount is given to you by the lender. Whereas in back end interest, the entire loan amount is given to you, and thereafter interest is charged at specified intervals of time. Normally all bank loans are back end interest. Example for a front end interest is nothing but bill discounting. That is, whenever you are discounting a bill with your banker, the banker discounts his charges and pays you the net amount but not the entire bill amount. So the bill discounting facility is one of the example for front ended interest. Clear? Then going to the next concept, annuities. Very important from this module. Annuities. What are annuities? Annuities is nothing but a series of fixed payments received over a fixed period of time. That is, series of payments being received over a fixed period of time is nothing but annuities. That is your installments, your EMIs. So for your banker, the EMIs which you are paying on your loan is nothing but annuity. That is a series of installments, a series of EMIs being received at a specified interval, that is a monthly interval or yearly interval or a semi-annual interval over a fixed period of time, say 10 years, 30 years or 20 years. These are nothing but annuities. Annuities are classified into two main categories, that is ordinary annuity and second is annuity due. Ordinary annuity is nothing but payment is being made at the end of each period. Say if you want to make payments, 5 installments of within 5 years at the end of each year, then every installment is paid at the end of each year. That is, first installment is paid at the end of first year, that is after lapse of 12 months from the date of taking of loan. That is called ordinary annuity. In other way, if the installment or the payment is being made at the beginning of the year, that is, I am taking the loan today and I am making the payment today itself, that is in starting of the period, then it is called ordinary due. Ordinary annuity, ordinary annuity and annuity due. Ordinary annuity is payment is being made at the end of the year, whereas annuity due is payment is being made at the beginning of the year. Now we have to calculate present value and future value of the total cash flows being received under ordinary annuity and annuity due. What is present value and future value? Time has a value, that is uh, your money has some time value, that is as the time gets lapsed, the value of the money changes. That is, amount earned, a rupee earned today is more valuable than a rupee earned tomorrow. That is, if you have 1 rupee in hand today, the value with this 1 rupee you may get 1 chocolate today, but whereas after 2 years with the same 1 rupee you may not get this 1 chocolate. For getting 1 chocolate you may require say rupee 2. That is, your value of the money has been decreased. That is, a rupee earned today is much more valuable than a rupee, equivalent rupee earned tomorrow. So time has present value and future value. So how to calculate them? The basic formula is future value is equals to present value into 1 plus r whole power n. N is the time period, number of years, and r is the rate of compounding or rate of discounting. Clear? The rate at which the percentage rate of interest at which the value of money is being varied, that is also will be given in the problem itself. So future value, always remember this formula, future value is equals to present value into 1 plus r whole power n. Now calculation of future value for ordinary annuity. Ordinary annuity is nothing but payments are being received at the end of each period. That is, for our example, for a period of 3 years we receive rupees 100 ordinary annuity, so 100 will be received at the end of each year. The rate of interest proposed is 10%. Now we have to calculate what will be the future value of these annuities. That is, if I am receiving an amount of rupees 100 at the end of each year for a period of 3 years, given the market rate at 10%, what will be the value of these series of cash flows after 3 years? So future value of my annuities. So 1 to 3 years, at the end of each year I am receiving this 100. So future value of this series is nothing but future value of each installment. So future value of this first installment is, future value is nothing but present value into 1 plus r whole power n. What is the present value? 100 into 1 plus, what is r? 10%. 10 divided by 100 in percentage, whole power n. What is the number of years? See, this future value I am calculating at the end of third year. At the end of third year. So at the end of third year, this first 100 is being received at the end of first year. So till how many years this 100 will be held? That is end of first year to end of second year, 1 year. End of second year to end of third year, that is second year. So total period for which this first 100 is being held is 2 years. 1 2 years. So 1 plus r whole power n. N is 2 for this first 100. Similarly, future value of this second installment. Future value of this second 100 is nothing but 100 into 1 plus r by 100 whole power 1. This 100 will be held for a period of only 1 year till the end of third year. Similarly, future value of third installment. 100 into 1 plus r whole power. This 100 is being realized at the end of third year and I am calculating my future value at the end of third year. So the time period is 0. So if I add up all these three, I will get the future value of this annuity. We have some various formulas for calculation of future value and present value of annuities. Those are very hard to remember. So simple thing is remember only one formula: future value is equals to present value into 1 plus r whole power n. Depending on whether it is ordinary annuity or annuity due or calculation of future value or present value, we can solve the sum easily. Similarly, this is future value. If we want to find present value, future value divided by 1 plus r whole power n. In the same example, if I want to calculate present value of ordinary annuity, so present value will be calculated at the beginning of the first year. So present value will be calculated at the beginning of first year, whereas future value will be calculated at the end of last year. Similarly, present value is nothing but present value of this, present value of this, and present value of this. Present value is nothing but future value by 1 plus r whole power n. So present value is equals to future value is 100 divided by 1 plus r is 10 by 100 whole power n. What is n? We look after this. See, first installment is being received ordinary annuity, that is at the end of first year, and I am calculating my present value at the beginning of first year. So this 100 will be held for a period of 1 year. So 100 whole power 1. Similarly, my second 100 is being received at the end of second year. I am calculating my present value at the beginning of first year. So beginning of first year to end of first year 1 year, and end of first year to end of second year another year. So this second installment is being received after 2 years. So 100 divided by 1 plus 10 by 100 whole power 2. Similarly, third installment 3 years. If I add up, all this gets, this total gives me the present value of total annuity. So whenever if the given is an ordinary annuity, that is payment is being received after the period, after the end of period, then my future value will be 210. Present value will be 123, so on. So always simple formula: future value is equals to present value into 1 plus r whole power n. N varies. N, how to arrive at n, that is whether it is ordinary annuity or annuity due, that is if payment is being received at the end of period or beginning of the period. You need to decide upon first. Then when we are calculating, that is if we are calculating future value, we will be calculating at the end of last period, that is end of last year. Similarly, if you are calculating the present value, then our calculation reference will be beginning of first year. In similar lines, we may calculate present value and future value for annuity due. See, calculation of future value for annuity due. So for annuity due, the payment is being received at the beginning of the year. So calculation of future value. Future value will be calculated at the end of the year. So at the end of third year, I am calculating future value of this 100. So this 100 is being received at the beginning of first year. So from beginning of the first year to beginning of the second year, 1 year. From beginning of second year to beginning of the third year, 2 years. Beginning of the third year to end of the third year, that is another year. So total this 100 is being held for a period of 3 years. So future value of this 100 is 100 into 1 plus 10 by 100 whole power 3. Similarly, second is whole power 2, third is whole power 1. Whereas in ordinary annuity, amount is being received at the end of first year. So that first installment will be held only for a period of 2 years. In annuity due, the first installment will be held for a period of 3 years. Similarly, for annuity due, if I am calculating the present value, first installment is being received at the beginning of the first year, and I am calculating the present value of the installment at the beginning of the year. So this will be held for a period of 0 time. So it is 0, then this will be held for a period of 1 year. That is beginning of the second year to beginning of the first year, 1 year. Third is 2 years. That is beginning of the first year to beginning of the second year, beginning of the second year to beginning of the third year, 2 years. So 0, 1, 2. Whereas calculation of present value of the ordinary annuity, it is 1, 2, 3. That is first installment will be held for a period of 1 year because it is being received at the end of the period, whereas it is being received at the beginning of the period. Clear? So only formula which we need to remember is future value is equals to present value into 1 plus r whole power n. Very important. Present value is nothing but future value divided by 1 plus r whole power n. If it is ordinary annuity, the payment will be received at the end of the period. If it is ordinary annuity due, the payment will be received at the beginning of the period. So depending on future value is always calculated at the end of the period, whereas present value will be calculated at the beginning of the period. Depending on whether it is ordinary annuity or annuity due or calculation of future value or present value, we can calculate accordingly based on number of years which is being held. Only formula, future value is equals to present value into 1 plus r whole power n. Very important, we'll get us 2 marks problem I guess from this. From entire module A of accountancy, we'll get around 20 marks. Module A of accounting will get around 20 marks. So module A is very important. Then most important topic of module A is bond valuation. That is how to value a bond. What is bond basically? See, I am a company or I am a government organization. I am in need of some funds. I need to have some amount, some funds. So what I do, either I borrow funds. I can borrow funds by way of bank loan. Another source of borrowing funds is by issuing bonds. I'll issue a bond. People will subscribe to my bonds. What I say, I am issuing a bond of say 100 for a period of 3 years with a coupon rate of 10%. That is, if you are subscribing to my bond, that is, if you are purchasing my bond, after 3 years you will get 100 rupees. But now for purchasing this bond you will pay some amount. What is the benefit you are getting? Every year I will pay you 10% of that amount, right? After 3 years you'll get back your 100 rupees. What is the benefit to the bond issuer? I'm in need of funds today. Simply by issuing a bond, I'm getting funds from my subscribers. That is funds from the purchaser of the bond. So whose bond will be purchased? That is the companies who are having good credit rating, who are having good market stand. Depending on their strength, the bonds will be subscribed to. So basic concepts of the bonds issued by the government, state or central government is called treasury bonds. Treasury bonds are nothing but the bonds issued by government. So various aspects related to bonds are nothing but, first thing is terminology used in bonds is face value. Face value is nothing but the amount actually borrowed or the amount which you receive at the end of maturity. That is, what is the value of the bond? If I am issuing a bond of 100 rupees, my face value of the bond is 100. That is, the 100 is being borrowed by the firm. Next is coupon rate. Coupon rate is nothing but the rate of interest which is paid on the bond. The interest rate at which the amount is being paid on the bond is nothing but coupon rate. Maturity period. Maturity period is nothing but the period for which bond is issued. Say 3 years, 1 year, 4 years. Redemption value. Redemption value is nothing but the value which a bond holder gets after maturity. So if I am buying a bond of 100 rupees for a period of 3 years, then after the end of 3 years, whatever amount which I get is nothing but my redemption value. Then market value. Market value is nothing but the price at which a bond is usually bought. See, 100 rupees bond for a period of 3 years with a maturity of 3 years with a coupon rate of 10% may be bought at say 90 or 110. Depending on the rate of interest prevailed in the market, the bond will be bought at higher the face value or lower the face value or equal to the face value. I can buy the 100 rupees bond at 100 or 90 or 110. So at what value I am purchasing the bond is called market value. Whatever the amount which I get at the end of period is called, at the end of maturity period is called redemption value. The rate at which interest is being paid on the bond for the bond period is called coupon rate. The total amount, that is nothing but the core amount of the bond, is called face value. Clear? Then there are various types of bonds, that is fixed rate bond, floating rate bond, that is coupon rate is fixed, coupon rate is floating. Then zero coupon bond, that is coupon rate is zero, no interest is being paid. Then treasury bonds, like I said, the bonds issued by the government. Then perpetual bond. Perpetual bond is the bond continues, and that is after expire again the bond will make, there is no exit to that bond. Then convertible bond. What is convertible bond? Is nothing but the buyer of the bond has an option that at the end of the maturity period, whatever the amount which we are getting will be directly converted into the equity shares in that company. That is called convertible bond. Then we have two options in bond, that is called callability and putability. What is callability option in bond? That is the issuer of the bond has an option to repay the bond before maturity. That is, I have purchased a bond of say 100 rupees for a period of 3 years. So nothing but at the end of 3 years, the bond issuer gives me, at the end of 3 years, bond issuer pays me 100. But if this bond carries an option of callability, then the bond issuer can repay this 100 before the period of 3 years, that is before maturity period. This option is called callability. So the callability option is nothing but bond issuer can repay the bond before maturity period. Similarly, other way is putability. The putability is holder or the buyer of the bond can force the issuer to repay the bond before maturity. If bond issuer is repaying the bond before maturity, it is callability option, and if the bond purchaser wants the issuer to make the payment before maturity, it is putability option. Then valuation of the bond. What is the value at which I need to purchase the bond? This is very important topic. This will continue in second video.